just wanted to briefly give you guys a quick background before you see any of these slides move. So if you don't see the slides move for a minute or two here, just it's on purpose here. Well, you may or may not know that there is over $2 trillion invested in the hedge fund world, and very few of us, and most of us listening, know very little about them. It is really a world exclusive to the institutions and the super wealthy. And unless you fall into one of those two categories, your ticket to access is basically unattainable. Now, one of the reasons it is such an exclusive industry is that it truly is run by the brightest minds on Wall Street, and the funds recognized as true funds, true hedge funds, usually perform extraordinarily well. The definition of a hedge fund is very broad, but when I say true funds, funds that are managing in assets well over $1 billion, would it be not the $100 million or the $50 million hedge fund that so many people claim as a fund. But they do it very, very well, and this in turn attracts the high-end clientele. And due to the performance, the price of entry into this world just continues to rise. Now, to play in the space, you must fit a certain financial profile and at the very least $1 million of capital to invest. There are some funds that require a net worth of $5 billion, an initial $100 million investment just to get in the door. Now, I've had the unique opportunity to get to know many of these wealthy clients, and I've been entrenched in this world for years. One of the main things that I have learned is that the super wealthy generally know what they know, and they know what they don't know. And that includes the markets and investing. Now, you'll virtually never see the ultra wealthy buy into hype or flashy marketing gimmicks. They don't chase a hot stock or hot sector or listen to some self-proclaimed guru or TV pundit. And they certainly do not attempt to expand their wealth on their own homemade trading systems. The fact is that this industry, whether you believe it or not, is 2 to 3 steps ahead of everybody. Now, as soon as the general public hears about an opportunity, the institutions and the real hedge fund pros have profited and have moved on with their clients, sometimes days, maybe even weeks earlier. Little do we know, the opportunity we are now hearing of and are now moving on is merely the leftover fruit. Now, with the quantum approach, we are attempting to change all of that and hopefully give you some insight to the psychology of the hedge fund mind and its core investing principles. The quantum hedge fund is a quantitative system that is designed for the everyday investor. The system focuses on procuring high-level, institutional-grade hedge fund research and making it available to the newbie investor and the seasoned investor alike. Now, this top-tiered, unbiased approach studies, analyzes, and most importantly, projects performance for equities within the S&P 500. Now, it detects and moves ahead of small shifts in the market, delivering precise, real-time research to you, generating fantastic profit potential for everyone's account, no matter how big or how small that account might be. Now, keep in mind, this information is every bit what the wealthiest clients use and the big guys are using. Now, normally access to this system is reserved for individuals who have that $1 million minimum of liquid capital to invest. Now, the reason quantum is now available and able to show the everyday investor what it does is that the system and its research, we've actually scaled it down. And at the end of the day, after all of the filtration and after all of the disciplines have been met, the system averages about 1, maybe 2 trades a week. And since you, the investor, maintain complete and total control of your own money and trading accounts, you are able to implement certain components of this quantitative system to your own investment processes immediately. Again, these trade ideas are generated by a sector-leading fund's proprietary quantitative model, implementing specific algorithms that withstand several levels of filtration to ensure the most accurate research and investment education available. Now, if you do not have the financial profile or means to participate in this hedge fund world, then this is the next best thing, and it's like nothing you've ever seen. That brings us to our long-term capital growth relative value arbitrage, kind of getting into the model itself. It's a statistical arbitrage, not an academic. So we may show you this approach to taking advantage of price differences and price imbalances. There we go. And it's just basically what we'll be talking about. Move on to the next. Now, this is important. This approach focuses on the S&P 500. Now, although complex in nature, the system keeps things very, very simple and adds all the extraordinary circumstances that affect your ability to profit. Now, ultimately, your ability to profit is measured by the market participants' interpretations of price and the ongoing battle between buyers and sellers to determine what that price should be. Now, these interpretations are being made by the largest institutions to the smallest trader and are influenced by several variables: extensive research or momentary impulse, quantitative or qualitative, brilliant or ignorant, reactionary or preemptive, emotions and feelings, logical or illogical thought, rational or irrational thought. Now, these variables of the buy-sell decision-making fall into one quantitative metric, and that metric we refer to as price movement dynamic, or PMD. By carefully analyzing the PMD along with all its connected supply-demand traits, such as range, volatility, and volume, we're able to optimize to forecast price points, and with that, generate massive profits. Now, we can assure you that by following along today, you'll be able to replicate components of this approach immediately, and at the very least, tighten up your own investment disciplines. Now, we target returns of 12 to 25% per every trade that we close. The system detects equities with this kind of upside potential. It is designed for that. And it detects these that will at least meet the 12% return threshold. We do long and short exposures. The quantitative model focuses on long and short with the occasional option overlay, usually around some sort of earnings announcement or event such as that. Only the S&P 500 stocks. The model adheres to its principal roots. It is not set up to chase a hot stock, hot sector, or penny stock. Low correlation. Trade frequency is about 1 to 2 trade ideas a week, like I said earlier. Again, it is not designed for day trading or quick turnarounds. Well over 10 years of research and development led to the launch of this proprietary model, along with 45 years of extensive backtesting, over 500 positions, and 275,000 data points. Quantum Advisory is designed to further the market knowledge and education of our members through detailed market research analysis. And many of the principles that will be discussed today are staples in our core trading philosophy. And many of the concepts you'll be able to implement into your own investment processes today. This brings us to the model. Quantum employs a proprietary quantitative model. For those that are unaware with what a quantitative model is, it is simply a model constructed to measure. Very simple. In this case, we are measuring the S&P 500. The quantitative model ranks the 500 stocks in the S&P 500 for internal measures of behavioral strength and consistency. So literally, real time in nanoseconds, 1 to 500, from most favorable to the least favorable. And it is continually rotating and shifting. The long portion of the research is constructed by analyzing a basket of the highest ranking equities in the S&P 500, while the short position of the research is constructed by selling short a variable size basket of equities that display the fastest drop in rank. Pretty simple. In other words, the system detects the fastest rising and the fastest falling equities in this structured framework in real time. Now, based on this data, the construction of the portfolio takes place. The system measures to 1/100th of a penny in lightning fast speeds this ranking and shuffling, and it is in constant motion. The systematic process utilizes disciplined risk control parameters and rules for trading, individual portfolio construction and rotation. Now for quantum, it looks for entry points that will give the greatest probability of achieving our minimum gains threshold without exception. Now this is a discipline we adhere to regardless, and this is something we believe you can easily implement into your processes. Now, trading methodologies include predefined entry and exit and stop loss rules, and the individual portfolio construction and rotation employ behavioral finance concepts as risk overlays. Now, the system constructs the positions by employing the rankings or the behavior of each equity, and based on that, the equities are being rotated and or properly entered or exited. Our quantitative process, or in other words, our measuring process. Concepts which the model employs to determine rank, to determine the rank of 1 through 500. We measure money flow, volume, trading range, trading consensus, high-low divergence, and relative relevance. Each concept you see here has been given a specific value which is then implemented into the model. I'm not sure if you use any of these concepts to help you with your investing process. If not, these are things we believe will help, especially once you commit to continually analyzing them. Key unifying components include time cycles, weightings, and data points. Time cycles, time scales vary across ranking criteria. Weightings, parameters adjust as a function of market cycles. And data points, high, low, open, close, volume. Basically what we are saying here is based on equities' rise or fall in rank, the system utilizes time cycles and data points to properly gauge those equities' behaviors and then weight them accordingly. For example, if, say, Gilead Sciences has consistently been a high-ranking equity in our model, but yet shows a uncharacteristic drop in rank, an exit is not necessarily inevitable, whereas another equity that has been in and out of the higher ranks and shows signs of inconsistency may be flagged, repositioned, or exited. Now, the model indicators algorithm. The following are 3 of the 12 indicators used by the model. Just to give you 6 of the 12: price adjusted volume, money flow, close on range. 3 others are time frame volume, high-low divergence, and range expansion or contraction. All have specific studies. Price adjusted volume, a commitment study that analyzes the increase in volume relative to the increase in price over a time period. This analysis gives an indication of the desire to own a particular stock, regardless of price fluctuations. For example, ABC Corp. ABC trades at $50 on January 1, 2012, with an average daily volume of 100,000 shares. 1 year later, ABC trades at $100 with an average daily volume of 100,000 with the same volume. The capital, price times volume, traded on the stock went from 5 million to 10 million a day. This indicates that the market participants are just as committed to this company at the new price than they were before, indicating more demand for the stock. Most traders would only look at volume, missing an important piece of this information. Now, money flow. Money flow, an intention study that analyzes volume on a positive price move versus the volume on a negative price move. Now, when equities rise on high on high volume and decline on low volume, it indicates that there is an underlying intent to accumulate stock without moving the price. This is what we refer to as strategic buying, or a form of strategic buying. For example, our ABC Corp went up Monday on 120,000 shares, down Tuesday on 78,000, down Wednesday on 56,000 shares, and up Thursday on 113,000. ABC moved in a positive direction on 233,000 shares and in a negative direction on 134,000. The ratio of up volume over down volume gives a metric that helps evaluate the behavior of a stock relative to its peers. A close-on range. Now this is an eagerness study that determines where an equity closes on its range, whereas the intraday activity is a fight between buyer and seller. The closing price identifies the winner. Now, by identifying the winner's position relative to the range, one can deduce investors' eagerness. Closer to the high equals eagerness to buy, closer to the low, eagerness to sell. Now, for example, ABC fluctuates between 39 and 41 throughout the day, 41 being the high, 39 being the low. Now, if the stock closes at 40.5, it is closed 25% off the top of its range. And when on average an equity consistently closes so closely to its high, it is a sign that accumulation is occurring. In simple terms, if someone really wants a product, they will go out and buy it. No questions asked. And they won't wait for a sale. The Apple product is a perfect example. People line up around the corner, they'll pay a premium, they go in and buy it. Now, while each indicator has been independently tested for predictive value, the model dynamically combines all 12. Again, 3 other indicators that I mentioned right at the beginning are time frame volume, high-low divergence, and range expansion contradiction. The time frame volume measures the degree to which buyers and sellers are traders, being short-term, and investors, being long-term, measures that difference. High-low divergence aims to determine the degree of excitement that exists around a stock, and that is part of the qualitative analysis. Range expansion and contraction analyzes the changing range over time. That brings us to our trading mythology. Now, based on behavioral finance concepts, this disciplined approach replaces emotional reactions with objective quantitative analysis, ensuring that human emotions do not cloud timing, trading, and capital decisions. In other words, a decision is never made on a gut feeling. Now, perspective theory or prospect theory, this outlines mistaken psychological inclination to hold losing positions while eagerly selling winning ones. That is not quantitative. This is purely human emotion. Now, we show you how to hold winning positions for the long term versus liquidation of failing positions. Now, the model is designed to maximize gains and mitigate the risk. Now, sunken bias demonstrates the average person's affinity towards certain sectors or companies based on past events that encourage excess holdings or weightings. We rotate and rebalance the portfolio regularly, establishing equal weighted positions in those that best fit our criteria. Now, many traders fall in love with certain sectors, say pharmaceuticals, because they've had some success in this sector, or they feel they may know more about them. It's critical that you weight and balance your portfolio properly. Every big reputable fund adheres to this simple rule. Cognitive bias illustrates the tendency of well-informed individuals to consistently do the wrong thing due to under-analysis. I'm sure a lot of us can relate to that. Now, we mitigate this risk by relying on extensive research, our disciplined ranking and trading guidelines, and the avoidance of panic selling or buying into exuberance, which happens all too often with others, not with us, with others. This behavior finance concept is a large reason why the everyday trader is at a distinct disadvantage. Some of this seems basic in nature. However, investing is basic in nature, and so is the psychology. It's when you go several levels deeper into the psychology is when you can see things that others don't and develop an advantage. We have values, numerical values for the psychological as well, and then our model reflects those numerical values with rumors, events, and whatever else it may be. Which brings us to our important part of the discussion is the management, the risk management. Everybody wants to understand how to manage the risk. We do it in 3 different areas: market risk, account risk, and trade risk. Now, we seek to educate you on how to minimize daily volatility and monthly drawdowns during times of market staggering or major market movements. Like mid-October of last year, during this crazy period, this past October, I wouldn't be surprised if our fund was the only fund that was actually up during that period. Now, employment of a stop-loss methodology in the weekly synopsis is given. Based on ranking criteria, we give specific stop-loss parameters. Some have tighter ranges than others, but they are always there. Adjustment of long-short exposures, utilizing broad market trends and behavior. Now, as market conditions change, so does our long-short positions. In fact, we are predominantly long, however, could easily flip those long-short ratios based on market conditions. Now, the discipline rules identify conditions to increase or decrease short percentages. If our model shows an equity to enter at 55, let's say for $55, but yet that equity slips to 45, long-term values usually show to cost average down based on strict disciplines that are always followed. In other words, we believe in the equities that the system delivers. The portfolio rebalancing to offset natural position variation comes in 3 different areas of market exposure: long, short, spread balance, and position weighting. Now, normally, with this scaled quantum version, we like to hold about 12 positions, 8 long and 4 short. But as conditions change, we could reweight those positions to 8 short, 4 long, or any other variation the system shows. It is highly, highly adaptable. We do continuous scenario analysis, which facilitates refinement and optimization of the risk management techniques, which is important to understand for our market risk. That brings us to the second leg of risk management, which is our account risk. Sensitive to position beta aims to dampen the research volatility. Appropriate diversification minimizes basis risk. Pretty simple. We rebalance so the portfolio is representing different sectors. Very important that you do that on your own as well. Adherence to disciplined use of stop losses and price objectives per position, such as event stops, price stops, trailing profit points. Percentage thresholds are based upon both quantitative trigger points and qualitative revaluation scenarios. As our equities climb, profit points are automatically implemented to mitigate risk. This is something that the everyday trader should implement. A systematic volatility stop. 2% drawdown triggers comprehensive monitoring and analysis. A 4% drawdown triggers an in-depth portfolio review, equity review, and liquidation, possible liquidation of the weakest positions. A 2% drawdown automatically triggers analysis of that equity. Depending on rank and historical behaviors, that equity may be exited. especially if this drawdown has taken place in an equity that has recently risen into the top of our rankings. Now, these type equities do not have the historical behavior, rank, or model value to hold a position in, so they are usually exited. However, a long-standing equity with high rank characteristics will be held unless it reaches the 4% drawdown. When it reaches the 4% drawdown mark, this might trigger a portfolio and position review and could result in liquidation of the weaker positions. And that brings us to the third leg of risk management, is trade risk. Now, disciplined trading methodologies and risk control measures seek to minimize potential drawdowns and position volatility. Volatility bands are utilized to determine technical low-risk entry. If you're not familiar with volatility bands, there are indicators that allow for volatility and price levels to be compared over time. Again, the low-risk entry points where risk-reward probability is the highest, this is so to quantify our price action. Entry and exit parameters are optimized in hopes to maximize our objective return versus stop-loss ratios, which is above 3-to-1. Now, risk overlays seek to mitigate basis risk, such as significant news events or company catalysts that may adversely affect the expected return. Now, like an earnings announcement is a great example of an event that could affect the return. An equity option overlay may be shown to provide an additional hedge by capturing a return on equity specific volatility as well as mitigating gap risk. We may implement an option strategy around a company's earnings announcement, for example. Now, qualitative research aims to identify information that may not be reflected in historical price data. This qualitative research is also placed with a value for our model. This allows for qualitative change, especially in the quantum portfolio and the curriculum. Now, trading S&P 500 equities ensures liquidity and transparency, so it's all there in front of you all the time. Our conclusive research, the average monthly return of the highest ranked section since 1967 more than double, 2.5 times the average monthly return of the S&P 500 over the same period. This is the year when you are able to actually, records of the S&P 500 started to be kept. Research demonstrates a powerful association between our rank and future return. As I said earlier in the presentation, a rank return regression of 500 positions over 550 months and 275,000 data points demonstrates a powerful statistical arbitrage between the highest ranked selections and the S&P 500. We've utilized robust backtesting methodologies, multiple double-blind studies, eliminated curve fitting, 45 years of market data ensured a wide gamut of market environments, carefully accounted for potential selection and sampling biases, including survivorship bias, attribute bias, and look-ahead bias. This is important because it's important that with any system that anybody is running to have at least, we obviously did it to the nth degree with our backtesting, but obviously the backtest is extremely important. Which brings us to our advisory characteristics. Again, as we stated earlier, in the quantum approach, where we've scaled the system down, we look to hold about 12 positions. 8 long and 4 short is our sweet spot. However, those ratios could change depending on the market conditions and how our model is adapting to those market conditions. Only S&P 500 equities published, full scalability, no capacity restraints, no leverage on the long side, minimum monthly alerts, limits trading costs and slippage. Winning positions aim to be held long-term to achieve long-term capital gains treatment. Based on behavioral science we covered in some of the former slides that we talked about. Losing positions are shown to be liquidated quickly via our stop-loss rules that we also talked about. Our differentiating factors: a fully proprietary quantitative process, novel and exclusive ranking system provides sustainable arbitrage and robust risk-return profiles, tested and optimized trading and risk control rules. This refers back to over 45 years of back testing, over 500 data points, 275,000 data points. Unique combination of risk management techniques, stop-loss procedures limit our monthly drawdowns and volatility, ongoing research, simulation, and development. Again, the model is highly adaptable, offers the ability to perform in changing environments. This is obviously important because the market is changing every day. And we pursue a mean of expansion versus a mean of reversion. It brings us to a historical performance chart that we have dating back to 1967. Shows if a dollar was invested in the index here in quantum based on our historical and 45 year back testing, this is basically what between the two would come out to. Which brings us to a sample trade. After all of the disciplines have been met, after all of the filtration comes down and a price point. It filters all the way down, and basically this is a sample trade that our actual members receive. And for this trade, we actually give the symbol and the price points, targeted entries, targeted exit. We give specific stop-loss parameters based on what specific fund is doing. And you can see here, this was a 30-day hold time, and we did about a little over 19% return, which is very common. Here's another sample trade, Alexion Pharmaceuticals trade that we did. This is about a year ago, but it just shows very similar. You guys get an idea of how it looks, what it is that we do. This trade was held for maybe 50 days, 55 days, whatever, and was that out for over almost a 45% gain. Almost trades we've closed this year have mostly been holds of about 45, 50 days is about the threshold. 45 or 50 days, all on double-digit gains. Our members, once again, this year are just killing it. This is a brief spreadsheet so you can know the equity we've been in. This is updated about a year ago. We'll be releasing the 2018 for future webinars soon, but basically the red figures are the losing trades that we had over since February in 1 year, from February 13 to February 2014, and it shows just how precise and accurate each we get in, how well it does. Which brings us to our subscription. We have a subscription that we actually offer to our members. You don't have the massive accounts. We actually have members that are little amounts of money that are actually following our equities and doing extraordinarily well. So it's It's right there for you. We do about 1 trade a week. We actually do a performance guarantee for our members. We certainly don't want to collect any sort of membership fees, or if it just doesn't perform. We work with a performance guarantee, so our members are covered. But if we would like additional information, here is our URL to a page where there's more information there, and it takes you to our pricing. Quantitedhedgefund.com is also our website. That's for our members. To become a member, you have full access to every single equity that, as long as Quantum Hedge Fund has been around. You can see all the historical data, all the current trades that we're currently in, and then every trade that we're in moving forward with full synopsis. So that's basically it. I hope you guys got a lot out of it. It's my pleasure to be able to present this stuff to you. It is somewhat complex in nature, but it is not that difficult. Any questions, again, please email us at info@quantum hedge fund, or you can call our 800, and please visit this URL.